Money is not the goal. It's a tool. Understanding how it works is the first step to mastering your financial destiny. Knowing how money works gives you the power to make it work for you rather than working for it your entire life. Imagine if you could finally understand the invisible force that controls nearly every aspect of your life. Money. Whether you're aware of it or not, money influences how we live, what we buy, and even our dreams. Today, I'm going to pull back the curtain on how money truly works and how this knowledge can change the course of your financial future. Stick around because understanding money is the key to unlocking your financial freedom. But what exactly is money? How does it function in our lives? Most importantly, how can you take control of it rather than letting it control you? The goal of today's video is to demystify money, break it down into simple terms, and give you practical insights into how it works. By the end, you'll have a better grasp of how to manage it, grow it, and leverage it to achieve the life you want. 1. What is money really? Money is far more than just pieces of paper or numbers on a screen. It's the lifeblood of economies and the engine behind every transaction. At its core, money is a medium of exchange, something we use to trade for goods and services. But it's also a unit of account. It measures value. A store of value. It holds its worth over time, and a standard of deferred payment. It helps settle debts. While we often think of money in terms of cash or digital balance, its true power lies in its ability to facilitate trade and ensure economic stability. Imagine living in a world without money, where you have to barter for everything, trading your phone for a meal or your TV for a pair of shoes. Complicated, right? Money simplifies transactions. Instead of bartering, you exchange money for goods and services. That's why money exists, to facilitate trade efficiently. Take an example in our daily lives. When you go to a grocery store and buy $50 worth of groceries, you aren't thinking about the complexity of the transaction. That $50 represents a portion of your time and labor exchanged for goods you need. The store owner then uses that $50 to pay for new inventory or employees. This cycle of trade is powered by the simplicity and efficiency of money, allowing our complex, interconnected world to function smoothly. 2. The creation of money. Many people think that money is created solely by printing bills and minting coins, but the reality is far more complex and fascinating. Most of the money in circulation today isn't physical at all. It's digital. This happens through a process called fractional reserve banking, where commercial banks create new money whenever they issue loans. In other words, every time someone takes out a loan, the bank doesn't just hand over existing money. It creates new money in the form of credit. This system allows economies to expand and grow, but also carries risks if not managed carefully. Imagine you're buying a house. You apply for a mortgage, and the bank approves you for a $200,000 loan. Now, the bank doesn't have that $200,000 sitting in a vault somewhere. Instead, it creates that money by crediting your account. In doing so, the bank has just increased the total money supply without physically printing more bills. The seller of the house now has that $200,000 in their account, and you have a new home, but no new cash has entered the economy. It's all done digitally through debt creation. An example of this can be seen in everyday banking transactions. Let's say you deposit $10,000 into your savings account. Under fractional reserve banking, the bank only needs to keep a fraction of that, say 10% as a reserve, and can lend out the rest. That means $9,000 can be loaned to someone else, effectively creating new money in the economy. This constant cycle of lending and borrowing is what fuels economic activity, allowing businesses to expand, individuals to buy homes, and economies to thrive. However, this also means that the stability of the system relies heavily on confidence and sound management of debt. 3. The power of interest rates. Interest rates are one of the most powerful tools in the financial world, quietly shaping everything from your mortgage payments to the overall health of the economy. Controlled by central banks like the Federal Reserve, interest rates dictate the cost of borrowing money. When interest rates are low, borrowing becomes cheaper, which encourages individuals and businesses to take out loans and spend more. On the flip side, when interest rates rise, borrowing becomes more expensive, discouraging loans and promoting saving instead. This simple mechanism has a profound impact on how money flows through the economy, influencing inflation, employment, and growth. Consider a scenario where the central bank lowers interest rates to stimulate a sluggish economy. Let's say you want to buy a car, and the interest rate on a car loan is only 2%. That low rate makes it affordable for you to take out a loan and buy the car now, rather than waiting and saving up the full amount. Multiply that across millions of consumers and businesses making similar decisions, and you have a surge in spending, which boosts economic activity. On the other hand, if interest rates rise to 7%, the higher cost of borrowing might make you think twice about that car loan, slowing down purchases and cooling off the economy. This ability to speed up or slow down financial activity makes interest rates a crucial lever in managing both personal finances and national economies. 4. Inflation, the hidden tax. Inflation is often referred to as the hidden tax because it slowly erodes the purchasing power of your money without you even realizing it. Over time, inflation causes the prices of goods and services to rise, meaning the same amount of money buys less than it did before. While a little inflation is natural in a growing economy, too much inflation can make life more expensive, draining your income and savings. Most people don't notice inflation right away, but its cumulative effect can be significant, affecting everything from groceries to gas prices and even housing costs. Imagine going to the store to buy your weekly groceries. Last year, $100 could fill your cart with all the essentials, but this year that same $100 barely covers the basics. This is inflation at work. For example, if the annual inflation rate is 5%, something that cost $100 last year will now cost $105. Over time, even small increases compound, eating away at your spending power. While your income may stay the same, your money is effectively worth less, which is why inflation is often compared to an invisible tax that affects everyone, regardless of their income level. Remember when a soda used to cost $1 and now it's $2? That's inflation. If inflation rises too fast, the cost of living increases, making it harder to keep up with day-to-day expenses. If you're enjoying this breakdown of how money works and want to dive even deeper into the hidden powers of wealth, be sure to check out our video titled Money Magic: Discover the Hidden Powers of Wealth. In that video, we reveal the secrets behind how the wealthy think about and use money. Trust me, you don't want to miss it. Please find the link in the description. And if you're finding value in this content, make sure to hit the subscribe button and turn on notifications to stay up to date on all things financial freedom. 5. The velocity of money. The velocity of money is an often overlooked concept, but it plays a vital role in understanding the health of an economy. It refers to how quickly money moves through an economy, how often it changes hands within a certain period. When money is exchanged frequently, it signals a high level of economic activity, meaning more people are buying, selling, and investing. A slower velocity of money, on the other hand, suggests that money is sitting still, with people holding on to it rather than spending or investing, which can stall economic growth. Imagine a scenario where you spend $100 at a local restaurant. The restaurant owner uses that money to pay their supplier, who then uses the same money to pay their employees. Those employees might spend it on groceries or rent, and the cycle continues. In this case, that $100 is rapidly circulating through the economy, contributing to economic growth. The faster money moves from person to person, the more goods and services are exchanged, creating wealth for businesses and individuals alike. When money changes hands quickly, everyone benefits because more transactions mean more income for everyone involved. On the flip side, when the velocity of money slows down, economic activity diminishes. For example, during times of uncertainty, like a recession, people tend to save more and spend less. Businesses also cut back on investments, fearing lower demand. This hoarding of money causes a slowdown in the economy because fewer transactions are taking place, reducing income for businesses and workers alike. The velocity of money, therefore, is a key indicator of economic momentum. When it's high, it points to a thriving, dynamic economy. When it's low, it's a warning sign that economic growth may be stagnating. Now that you understand how money works, you're just scratching the surface of a much larger world. Next, we're going to explore something even more powerful, the idea that money is energy. In our upcoming video, Unlock Financial Flow of Money. Money is energy. I'll show you how to tap into the energetic flow of money and transform your financial situation for the better. You won't want to miss this because this knowledge could revolutionize the way you think about and use money. So before you go, be sure to subscribe and click that notification bell. You've taken the first step toward mastering your money, but there's so much more to come. If you're excited about transforming your financial life, leave a comment below, share this video, and start the conversation about how money can work for you. The content in this video is for educational and informational purposes only. It is not financial advice. Always consult with a professional advisor before making any financial decisions.